Central banks bought more gold in the last 3 years than in the previous 2 decades. Over 1,000 tons a year, 2022, 2023, 2024, according to the World Gold Council, the fastest official accumulation since the 1960s. The last time the world's governments repositioned their reserves like this, an entire monetary order was being born in a hotel ballroom in New Hampshire. And the time before that pattern reversed, when central banks started pulling gold instead of dollars, that order died in a single televised announcement. Nobody talks about this, but the buying pattern we're watching right now has only one real precedent, and it didn't end quietly. July 1944, the Mount Washington Hotel, Bretton Woods, New Hampshire. The war is still raging. Allied troops have been on the beaches of Normandy for less than a month, and yet, 730 delegates from 44 nations are crowded into a resort in the White Mountains, arguing about the shape of money for the next century. The hotel had been shuttered for 2 years. Staff were hired back in a rush. The plumbing barely worked. The corridors smelled of fresh paint over old damp. And the gold room, a small chamber off the lobby, gilded ceiling, heavy drapes, became the place where the final documents were signed. Out of that room came a system that would make the United States dollar the center of the entire global economy. 44 nations agreed to peg their currencies to the dollar, and the dollar, alone among them, would be convertible into gold at exactly $35 an ounce. One currency, anchored to metal, holding up everything else. Here's what makes that month worth your next 15 minutes. The system designed in that ballroom lasted 27 years. It collapsed in stages, a slow leak, then a rush, then a single Sunday night in August 1971 that ended it forever. And in 2025 and 2026, a bloc of nations representing roughly 40% of the world's population is openly discussing whether to build something that roots around the dollar, possibly linked, in some proposals, to gold. The currency doesn't exist. It may never exist. But the conversation itself, who holds the reserves, who sets the rules, who gets to print the money everyone else needs, is the same conversation those 730 delegates had in 1944. To understand whether history is rhyming, you have to understand how the dollar won that argument in the first place, and then how, decision by decision, it lost the gold that made the victory possible. Start with the rise, because the dominance was real and it was earned in the ugliest way possible. By 1944, Europe's economies were rubble. Britain, the previous owner of the world's reserve currency, was effectively bankrupt, kept alive by American Lend-Lease aid. The United States, meanwhile, held somewhere around 20,000 tons of gold, by most estimates roughly 2/3 of all official monetary gold on Earth. American factories were producing about half the world's manufactured goods. When John Maynard Keynes arrived at Bretton Woods arguing for a neutral international currency, he called it the Bancor. He was arguing from a position of brilliance and weakness. Harry Dexter White, the American negotiator, was arguing from a position of 20,000 tons. The Americans won. The agreement, signed July 22, 1944, made the dollar the anchor. Every member currency pegged to the dollar within a 1% band, and the dollar redeemable in gold at $35 an ounce for foreign governments and central banks. It also created 2 institutions to police the system: the International Monetary Fund and what became the World Bank. Now hold that image, the gilded ceiling, the signatures, the 2/3 of the world's gold, and place the modern frame beside it. In August 2023 in Johannesburg, the BRICS bloc, Brazil, Russia, India, China, South Africa, announced its first major expansion, and on January 1, 2024, Egypt, Ethiopia, Iran, and the United Arab Emirates formally joined. Indonesia followed in January 2025. Summit after summit, Kazan in October 2024, Rio de Janeiro in July 2025, the communiques have circled the same themes: trade in local currencies, alternative payment systems, reduced dependence on the dollar. Russian officials have floated a settlement unit. Some commentary has speculated about gold linkage. None of it is operational. There is no BRICS currency, no announced peg, and the member states themselves disagree publicly about how far to go. India, in particular, has said it has no interest in replacing the dollar. But here's the part the headlines miss. In 1944, the new system wasn't operational either. It was a set of meetings, communiques, and arguments about who would hold the anchor. The architecture came later. The conversation came first. For about a decade and a half, the Bretton Woods system worked better than almost any monetary arrangement in history. At its peak in the 1950s, world trade was expanding. European economies were rebuilding under the Marshall Plan's roughly $13 billion in aid. Exchange rates were stable, and currency crises, the plague of the 1930s, had nearly vanished from the developed world. Economists would later call the period from roughly 1950 to 1970 a golden age of growth. The dollar was, in the famous phrase, as good as gold. Better, actually. It earned interest, and gold just sat there. Foreign central banks were happy to hold dollars instead of metal. Nobody could have predicted, watching the system hum in 1955, that the very feature making it work was also the crack that would break it. Because here's the flaw, and a Belgian-American economist named Robert Triffin stood in front of the United States Congress in 1960 and explained it out loud. For the world economy to grow, it needed more dollars. Dollars to settle trade, dollars to hold as reserves. The only way those dollars could get out into the world was for the United States to spend more abroad than it earned, to run deficits. But every dollar that piled up in a foreign vault was a claim on American gold at $35 an ounce. The more dollars circulated, the thinner the gold coverage became. The system required the United States to undermine its own anchor in order to function. Economists call it the Triffin dilemma. Picture the gold room as exactly what its name says, a room with one door and a fixed amount of gold inside, while the hotel above it keeps adding floors. Every new floor is another set of keys to that same door. The building grows, the room doesn't. Eventually, someone counts the keys, counts the gold, and does the arithmetic. The arithmetic arrived right on schedule. By 1960, foreign dollar holdings had grown so large that, for the first time, dollars held abroad exceeded the value of the American gold stock backing them. The keys outnumbered the gold, and the warning signs stacked up from there. 5 decisions, each one defensible alone, lethal together. First, Washington kept running the deficits. Military spending abroad, then the costs of the Vietnam War escalating sharply after 1965, alongside expanded domestic programs. Dollars flooded outward and were not matched by gold coming in. Second, in October 1960, the London gold price spiked to around $40 an ounce, well above the official $35, and instead of treating that as a verdict, the major powers treated it as a nuisance. In 1961, they formed the London Gold Pool, the United States and 7 European nations pooling reserves to sell gold into the market and force the price back to $35. They chose to fight the price rather than fix the imbalance. Third, the United States kept the $35 peg sacred even as inflation eroded it. The price had been set in 1934, and by the mid-1960s it was visibly, mathematically stale. Fourth, capital controls and accounting games. The interest equalization tax of 1963, pressure on allies not to redeem, papered over the leak instead of plugging it. Fifth, and most human, everyone in charge assumed someone else would blink first. Sound familiar? Because in 2022, After sanctions froze roughly $300 billion of Russian central bank reserves, central banks around the world looked at their own dollar holdings and started asking a quiet question. What is a reserve worth if it can be switched off? The IMF's own data shows the dollar's share of global foreign exchange reserves drifting down from about 71% in 1999 to somewhere near 57 to 58% by 2024. Still dominant, but the lowest in roughly 3 decades. And the gold buying, over 1,000 tons annually for 3 straight years, with the People's Bank of China, Poland, Turkey, and India among the steady reported buyers, is the modern echo of European central banks in the 1960s, quietly preferring metal to paper claims. Not a panic, a preference. That's how it started last time too. One man refused to be quiet about it. Charles de Gaulle, president of France, gave a press conference in February 1965 in which he called for a return to the discipline of gold and attacked what his finance minister famously labeled America's exorbitant privilege, the ability to pay for deficits with money only America could print. And France didn't just talk. Through the mid-1960s, the French government systematically converted its dollar reserves into gold, by some accounts sending naval vessels and aircraft across the Atlantic to carry the bullion home to Paris. Picture the basement of the Federal Reserve Bank of New York, 80 feet below the streets of Manhattan, where much of the world's official gold sat in country-labeled compartments behind a 90-ton steel cylinder door. For years, settling accounts meant forklifts moving pallets of bars a few feet, out of one nation's cage into another's, the fluorescent light flat on the metal, each bar around 400 ounces, 27 pounds of weight per bar in a handler's gloved grip. Now the bars weren't crossing the room, they were leaving the building. France pulled out of the gold pool in 1967. The polite fiction was ending. Then came the collapse, and once it started, it moved on a timeline you can read like a countdown. November 1967. Britain devalues the pound by 14%, from $2.80 to $2.40, and the devaluation of the EU system's second currency sends speculators straight at the first. The London gold pool starts hemorrhaging. In the final months, it was losing gold at a pace that contemporary accounts put in the hundreds of tons, with the worst single days seeing demand so heavy the U.S. Air Force flew gold from Fort Knox to London to keep the sales going. March 14, 1968. The pool sells off so much in one day that the members capitulate. The London gold market closes for 2 weeks. When it reopens, the official $35 price exists only between governments. The free market price floats above it. The pool is dead after 7 years. The anchor is now a fiction, maintained by mutual agreement not to test it. The testing came anyway. Through 1970 and into 1971, the American gold stock kept shrinking, from over 20,000 tons in the late 1950s to roughly 9,000 tons, barely a quarter of what would have been needed to redeem all foreign-held dollars. In May 1971, West Germany, tired of importing American inflation, let the Deutsche Mark float. Dollars stampeded into marks and Swiss francs. In early August, Britain, the closest ally, requested cover for its dollar holdings, a request widely read in Washington as a step toward redemption. The interpretation may have been overheated, but it landed in a White House already at the edge. On Friday, August 13, 1971, President Nixon took 15 advisors to Camp David in secrecy. Treasury Secretary John Connally, Fed Chairman Arthur Burns, a young Paul Volcker among them. They argued for 2 days. Burns warned against breaking the gold link. Connally's view prevailed, and on Sunday night, August 15, 1971, Nixon went on television, interrupting of all things the Western drama bonanza, and announced that the United States was suspending temporarily the convertibility of the dollar into gold. Temporarily. That word is still doing its work, 54 years later. The window never reopened. 27 years after the signatures in the gold room, the system built there was gone. Closed not by an enemy, but by its own author in 19 minutes of television. The aftermath rewrote everyone's ledger. The Smithsonian Agreement of December 1971 tried to patch the system with a devalued dollar at $38 an ounce. It failed within 15 months. By March 1973, the major currencies were floating freely, and the world has lived on unanchored paper money ever since. Gold, freed from $35, ran to $180 by the end of 1974 and touched $850 an ounce in January 1980, a more than 20-fold rise from the old peg. The 1970s delivered the inflation the system had been suppressing. U.S. consumer prices rising over 11% in 1974 and over 13% in 1979, two oil shocks, and a stretch economists named stagflation because nothing in the old textbooks described it. Ordinary savers watched cash lose roughly half its purchasing power across the decade. And yet, and this is the part the doom narratives always skip, the dollar didn't die, it adapted, anchored now to the depth of American markets, the petroleum trade, and eventually Paul Volcker's brutal 20% interest rates in 1980-81. The dollar remained the world's reserve currency without a single ounce of gold behind it. The lesson of 1971 cuts both ways. Monetary orders that look permanent can end on a Sunday night, and the currency at the center can survive the end of its own system. So now bring it forward, because here's why this matters today. The BRICS conversation of 2025 and 2026 is not a currency. Let's be honest about that. It is a series of proposals, payment system pilots, and summit language about local currency trade. The blunt truth is that the bloc lacks what the United States had in 1944. A single dominant economy willing to anchor everyone else, deep open capital markets, and mutual trust among members. China and India, the two largest, have unresolved disputes of their own. Most economists consider a launched, gold-backed BRICS currency unlikely in any near time frame. But the Bretton Woods story suggests the launch was never the thing to watch. The thing to watch is the reserve behavior, and the reserve behavior has already changed. Central banks bought 1,082 tons of gold in 2022, over 1,000 tons again in 2023, and roughly the same in 2024. Triple the average pace of the 2010s. Gold pushed past $2,600 an ounce in 2024 and kept climbing into 2025. The dollar still settles the overwhelming majority of global trade and sits on one side of nearly 90% of foreign exchange transactions by the Bank for International Settlements count. Dominance, plainly. But dominance was also the word in 1965 when the bars first started leaving the basement in New York. The shift didn't announce itself. It accumulated pallet by pallet until one Friday in August it forced a decision. Quick aside, I've stood outside that hotel in New Hampshire, and the strange thing is how small the gold room is. The room where the world's money was redesigned would fit inside a suburban living room. World orders don't need big rooms, they need a moment when enough people stop believing the old arithmetic. None of this tells you what to do with your savings, and it shouldn't. This channel reads ledgers, it doesn't write yours. What history does say is narrower and harder. Reserve systems end not when a rival launches something better, but when the incumbent's own arithmetic stops closing, when the claims outnumber the anchor, and the holders quietly start preferring the anchor itself. In 1944, the anchor was American gold, and the world signed on. By 1971, the claims had outrun it, and the world floated. In 2025, the claims are dollars and treasury debt, over $36 trillion of it, and the quiet preference, measured in tons per year, is once again metal in national vaults. Does that mean the order is ending? History suggests these transitions take decades and usually require a war or a crisis to complete. It also suggests they are invisible right up until they aren't. So the question the Gold Room leaves us with is the one those 730 delegates thought they had answered forever. Who holds the anchor when the world stops agreeing on whose paper to trust? And would we even notice the moment the answer changed? If you want to see what happens when a reserve currency actually loses the crown, how sterling went from ruling world trade to begging the IMF for a bailout in 1976, watch the next video, because Britain already lived the ending everyone now argues about.